Welcome back to America's Commercial Real Estate Show. I'm Michael Ball. The excitement is brought to you by realcrowd.com. They do commercial real estate crowdfunding. Do check them out. Well, today we're talking about legal concepts today. What are some important legal things that are coming up in today in kind of the new world of commercial real estate? Well, please welcome my next guest. It's Rusty Fleming, and Rusty is a partner with the law firm of Nelson Mullins. He's here in Studio One with us. Rusty, thanks for being with us.
Thanks, Michael. Glad to be here.
Well, we appreciate it. And, Rusty, it seems like it is kind of a new world, right, of commercial real estate. You're on the front lines. You're representing a lot of lenders, dealing with borrowers. So what are you seeing today from your desk related to underwriting? What do you see?
Yeah, so we're seeing a wide variety of deals. Bridge, life company, CMBS. And I would say underwriting at the life companies is the same as it always has been. Fairly conservative and down the middle. Where we're seeing some things that you may have seen, 2005, 06, 10-year IOs, pure springing cash management. They're still hanging on to springing cash management, but 6, 8, 10 months ago, you would see in-place cash management, or at least an in-place lockbox with sweeps over to the borrower. Now they're dormant accounts that aren't even triggered. So we're seeing erosion there. I would say, on most part, leverage is about the same. Maybe ticking up a little bit in the bridge space given the number of lenders there. But I would say primarily, cash management is one place, and then interest periods are getting a little longer than we've seen in more recent vintage closings. Is
that because there's a lot of lenders looking for deals?
Definitely a lot of lenders. Yeah. We were out at the MBA, and there were 90 bridge lenders at that conference. And it was similar to that in CMBS. Just a few years ago, everyone had a CMBS shop, and then the herd got cold a little, and I think that helped in a lot of ways, and it did not hurt borrowers' availability of capital. And we're seeing the same thing in the bridge space. Just tons of capital out there. People are chasing yields. People getting 40, 50 term sheets on a tertiary market value add deal, which no one would touch 2 years ago. Yeah. So yes, there is competition, which is eroding underwriting to some extent. But I guess the counter to that is a lot of these guys are leveraging. There are a lot of private equity funds and hedge funds that are in this space, and so other types of debt funds. And so they are leveraging their balance sheets to make the loans. And so there is a check and balance with their own lender on the back end. And then a lot of these are destined for CLOs. And so you've still got to check the box there. So we're still seeing independent directors, non-consolidation opinions on the closing side. Those are still fairly routine, even for deals that in the $12-15 million range, and in the good old days, non-cons were 50 million and above, or independent directors much higher. So those things are still out there, but there's definitely competition, and it's pushing a few buttons.
Yeah. Are you seeing more equity investors becoming investors in debt?
Absolutely. Yeah. I think people are chasing yield where they can get it, but at this point in the cycle, they're also looking for a little bit of safety. So it's a balance. So we have definitely seen more traditional equity players dip their toe in the mezz lending, which between pref and mezz, there's little distinction sometimes. But we have seen them get more comfortable in the mezz space. I think senior lenders are more comfortable with the mezz than they are with pref in some instances. So we've definitely seen that. We've seen and we've seen them take senior positions as well. Just wherever they've got to put their money to work. It's a burning hole in their market.
That's right. Should borrowers be concerned who the real actual lender is?
Absolutely. This is something we've talked about a lot recently, and that's the rise of shadow banks, non-traditional lenders. And there's a couple things at play there. One, what's their source of capital, and is it a true long-term source, especially in the bridge space, because almost all of those are structured with some type of future funding component. It's a turnaround play. And so if you've got a major PIP that's going to be funded over 2 to 3 years, or a capital improvement plan on a apartment that you're trying to take from a C to a B class, you need, from the borrower seat, to be sure that your funding source is still going to be there next year when you have that need. And so that I think borrowers are sometimes not aware of that or cognizant of it. They're looking at proceeds, they're looking at rate, they're looking at structure, but they're not really thinking about, who am I doing business with here? What's their exit strategy? Does that exit strategy impact me? Is it CLO? Are they putting it on a repo line so that the loan may be owned by another bank or another institution? That might be a positive thing, but you may lose the control of who you're dealing with. And so I think borrowers definitely need to be aware of that. We've heard consistently from borrowers that they did not have a good experience in the downturn with CMBS servicers, and so they're more apt to go to bridge lenders because they feel like there's more control there, and it's not going to go into a CMBS REMIC, but they're still going to probably go into a CLO. They're going to be dealing with the servicer. I think that borrowers should definitely be aware of who they're doing business with.
And also, I guess, be concerned about who's seeing their financial information as a borrower based on the type of lender and what they're doing with it, right?
Sure. So the sophisticated borrowers that we're dealing with are definitely asking for confidentiality provisions, and they're tightening up the traditional secondary market type of provisions that you see in loan documents to make sure that their information is not shared with the world. Also, we've seen borrowers, particularly if they're hotel is a good example where they may be a very large Marriott franchisee. They've put some restrictions now in allowing competitors to see their financials, putting restrictions on who the assignees of the loan can be, so that they're not getting in bed with someone that they don't want to be. So we've definitely seen that from borrowers over the last 2-3 years.
Yeah, it's interesting that you could really protect yourself there, and without thinking about it, can get in a bad situation. Well, you said there's a good bit of lenders out there. Are you seeing any trends on rates yet from your desk rising?
Over the last 6 months, as treasuries have gone up, spreads have tightened. So there hasn't been a lot of change. I think that we will see that over the course of the year, and I think spreads have moved out a little recently. I definitely think that there will be higher rates, but
haven't really seen it yet.
Not really yet, and it's still pretty good all in. I closed the deal yesterday. It was a fixed rate deal, and they locked in the mid-4s. So. And then on a bridge deal, we're seeing... Was
that existing property?
Yes, that was a stabilized asset.
Okay.
Closed a bridge deal. It had a LIBOR plus 5 if the debt yield was above 7 or below 7, and LIBOR 4 if it got above. So we're seeing some creative things there as well.
Yeah. And it used to be the days you go get a loan and the documents or the documents. It's like sign it or you don't get the loan.
Right.
Are you seeing any more flexibility with lenders?
I think so. I think that's part of the competition out there. So people are being more flexible. I still think there's those things that you can't touch. The bad boy carve outs. I mean, you can massage them, but for the most part, they are what they are.
Yeah.
Most people are not giving grace periods on payment defaults, and cash management waterfalls. They're not reordering those to move the borrower up in the waterfall. So there are still things that are must-have SPE provisions, but I would say on balance, I think most lenders try to be reasonable, and if it's not going to ding the lender in whatever their secondary market strategy is, they're willing to work with borrowers.
Okay. And you guys are doing loans all over the country, and you have some states that are judicial foreclosure and some that are non-judicial, and you can do a foreclosure a little faster in those states. Are any of your lenders or borrowers seeing any difference in terms or documents per se with judicial states versus non-judicial? So if I'm developing in multiple states or investing in multiple states, might I see anything different?
I don't think we're seeing much difference there. I think national lenders are comfortable that they know what they're getting as they move into states. I will say that more lenders are choosing New York law as an overall governing law, and then just using the local law of the state for the security documents. Of course, that doesn't impact the judicial, non-judicial issue, but it does impact borrowers for opinions. It can be more costly to close. So that's another thing that I think sophisticated borrowers are asking: do I really need to go to New York? Do I really have to have a Delaware entity? Those types of things that are seen from a borrower seat as cost items, but from a lender seat, are pretty important.
Okay. What would be a closing tip for lenders today?
I would say have a good exclusivity period on your term sheets, because people are dual tracking, tri-tracking, shopping deals like never before, and get an upfront deposit for the same reason. I think that's probably the number one tip. I think the lenders are doing well with their underwriting. So, but I think that's where it's the competition that's we've seen some issues in that.
How about
area.
A closing tip for borrowers today?
Yeah, I think borrowers need to be aware of the closing requirements and the timeline. Have realistic expectations. That's probably.
Better start early, maybe.
Yeah, start. Don't call 30 days before your maturity date, which we've seen.
Right.
And then just be forthright. Particularly with very few people made it through the downturn unscathed.
Right.
And just don't play hide the ball with those items. Most lenders know that. They can work through that.
Right.
But where we see problems or where borrowers say, oh, we didn't have any problems, and then you get your credit searches and you got this blip and that blip, and there's usually a story there, but if you just tell the story and be upfront about it, it's a lot easier than finding out on the back end.
Yeah, that's funny. We do a lot of work for banks and have done a lot of work for banks. And I remember one of the banks said, "Oh yeah, we want you to sell these notes. We want you to sell these REO, blah blah blah." And they said, "Wait a minute. Are you one of our problem borrowers?" No, we're not. Okay, good. All right, we can move forward.
That's right. Well,
Rusty, great information. Thanks for joining us.
Thanks for having me.
And thanks for joining us, and stay with us. We'll have more legal tips for you related to commercial real estate trends today. Stay with us. I'm Michael Bull. This is America's Commercial Real Estate Show.